Welcome to IMARC and to Sydney. It's great that you've made the long trip from Washington to come and talk to us about this essential issue of securing supply chains for critical minerals. Look, I believe that late last decade, when you were US Assistant Secretary of State for Energy Resources, you effectively created the US foreign policy on critical minerals way before it was the hot topic that it is today. Things have moved on quickly in the last 4 to 5 years since then. What's your assessment now as to how secure we have those supply chains at the moment? Where are we at in that process?
Yeah, thank you. And it's absolutely fantastic to be back in Australia. You're exactly right. In 2018, 2019, there was very few people talking about this issue set, whether for the purposes of discussion from the lens of climate change and addressing the climate crisis and why minerals, metals, really are the groundwork for that energy transition, or from the purposes of security and geopolitical statecraft. At that time, it started initiating discussions about how we have a policy response, a coordinated one across the U.S. government, and the question was kind of, why are you bringing this to my attention? Why are we talking about this? We're no longer, that question is no longer asked. Now the question is, what are we doing about it? I think to answer the question, where are we? It's very mixed. I think first having an understanding of what the problem is, then we can try to address it. We understand what the problem is. But in terms of our tools to remedy the problem, it's still to be determined. We've laid lots of groundwork, and you've heard Peter comment, the U.S. government, how important the U.S. government is in the world, is just a government. And governments in our system still effectively can establish parameters, but government doesn't actually execute anything. It's the private sector, it's capital markets, it's business. That's who drives change. And we haven't seen the levels of capital formation and deployment of capital, the scale and the speed to address the challenges ahead.
Well, I saw an article you wrote recently in The Hill, that's the Washington-based politics and policy news service, when you talked about the importance of breaking China's stranglehold, as you called it, over the energy transition. Do you think the US and its allies are getting the building blocks in place to actually do that?
I do. I think that you're seeing this, first we have to understand, well, who should be in this? How do we coordinate this? And I also want to suggest, I think it's important that the discussion not necessarily be averse to China. I think China, ideally, you would want to see China be a part of this, but it requires a certain recognition of a certain value set and the way we're all going to kind of work together. If you have a shared objective, you have to have a certain set of rules. And so you see this transformation of the global economy in the world of the energy transition. Who shares the rules? Who shares the certain values? And to what extent can you collaborate? And there are opportunities for do that. The U.S., and I've heard, this is the third day here, there's been considerable discussion around the U.S. policy prescriptions, including the Inflation Reduction Act, which allows for U.S. subsidies or tax credits to accrue, not just to U.S. content, but also from free trade agreement countries, allied countries. And of course, there's no greater ally in this realm than Australia. So I think it's an incredible opportunity.
The issue of China's dominance, though, in critical mineral supply chain, I mean, we've seen a few examples, haven't we, lately, of China exercising that influence. I'm thinking of restricting exports of rare earths, gallium, and just recently just graphite. How serious a threat do you think this is to the energy transition and to achieving those global goals of net zero emissions?
It's absolutely fundamental. We have to get this right. You cannot be dependent, and it's not even a matter of great power competition as described, but simply, the COVID example demonstrated that we ought not have all of our, be dependent on any one source of supply because things can happen. So you want to have a degree of redundancies built in. I think there's going to be also an increasing move in the United States that corporates, publicly traded companies will have to have contingency plans, a matter of public disclosures, as they have to disclose other forms of risk. To what extent is your ability to deliver the product to your customer, and therefore that affects your share price, is going to be constrained by your dependency on that supply chain. And so this is absolutely fundamental. We have to get it right, but it's going to require markets to provide the incentive structure to allow that to happen. You mentioned the banning of rare earths, gallium, and recently the announcement to ban graphite. These are celebrated cases, and we have to talk about them. But I think in terms of market formation, more insidious is China's ability as the dominant supplier of these metals and materials to the energy transition, as well as be the manufacturing powerhouse that it is. Their real strength is their ability to undermine the economic thesis for an investment in a democratic state where you have to have a certain response to shareholders and return on investment and these kind of simple base Western market kind of orientation. They don't have to do that. And so their ability to dump product on the market can destroy the incentives to invest in certain countries. I mean, Australia, I think, has the highest labor costs in the world. Those aren't going to go back. All the polls are to increase worker protections, increase environmental quality. So we're competing. If the commodity if your success as a business is simply based on if the stuff I shovel up, I can produce less than somewhere else, then we're in a downward spiral. There's going to be, back to this values question, there's going to be a reorientation of the pricing and to extract a premium. It hasn't happened yet. It's happening in certain pockets for certain luxury segments. But this is the direction. And I think this you'll see capital formation around this, because how else do you develop the alternative supply chain if your greatest competitor can undermine your investment?
To what extent do you think investors are being scared off by these sorts of factors? Presumably there must be quite an undermining of confidence in the whole market.
Yeah, absolutely. In this example I just provided, I mean, there's one company that invested to build a cobalt mine in the United States, an Australian listed company. Even this company was backed by some U.S. government loans. And this occurred in May. China announced that they wanted to assert greater control over cobalt pricing, and then that company suspended operations because it didn't make sense for them to continue to make these investments, develop the project. So this is where things are headed. We're going to see this reorientation, and that's why the Inflation Reduction Act is important, because it provides there's a recognition that there's not a level playing field. There's not a level playing field. So, you know, President Reagan famously said, if you want more of something, subsidize it. If you want less of it, tax it. And so we're saying in the Inflation Reduction Act that the U.S. wants more U.S. content and those from allied countries with which we have free trade agreements. So we're going to subsidize those.
Yeah. So on the Inflation Reduction Act and that question of allies, obviously Australia is one of those allies. What might we see evolve in terms of Australian participation then in critical supply chains for, you know, critical minerals for the US? How might that evolve in terms of the shape? And what does it mean also for US investment in critical minerals mines here?
Yeah, I think Australia is a dominant producer in certain key materials, in particular lithium, as well as others. I think you're going to see having Australia be a core partner, whether it's within the Inflation Reduction Act or I created some programs, bilateral initiatives to coordinate around critical minerals in the former administration. I also think there's a lot of discussion in the U.S. around the world. I was in Europe last week, and the level of angst about U.S. political dysfunction. This is an important area of complete unanimity, recognizing that we have to develop a values-based, responsible, and secure supply chain to address whether it's through the lens of security or through climate action. And so this is an enduring, and to that extent, Australia also has some of the highest approval levels of any country in the U.S. So I think Australia has been and will remain really an anchor to this shared strategy.
I've read some comments of yours, though, voicing some concerns about having safeguards in the Inflation Reduction Act, just to make sure that US taxpayer incentives don't find their way into the hands of Chinese firms or other non-allied firms. And then we've got this concept of foreign entity of concern and how this definition might be applied in the IRA. What are your thoughts about how that might work? Given, for example, that most of Australian lithium is processed in China, does that not pose a problem there?
Yeah, so the foreign entity of concern is a provision in the Inflation Reduction Act that it prohibits subsidies from the tax credit to accruing to a foreign entity of concern. And what is that? It's effectively China, Venezuela, Iran, and Russia. We don't want to provide U.S. taxpayers funding subsidies to go and arm support regimes that are antithetical to democratic values. That's the idea. There is a question that even though the president celebrated over a year of the Inflation Reduction Act passage, the Department of Treasury has yet to issue guidance to figure out exactly how do you figure out this foreign entity of concern. Why is it relevant? The language of the Inflation Reduction Act provides tax credits $7,500, which is effectively split in half, for domestic minerals, one half, or domestic processing of those minerals, the other half, or that would also apply to a free trade agreement country. So in the example that you provided, you've got lithium being mined in Australia, shipped, I think more than 75% of all global lithium is refined in China, shipped to China, and then it's sent to a US OEM. How would that work in practice? First, I have to be honest and say I don't know because the guidance hasn't been written yet, but what I would presume would happen would be that tax credit is effectively split in half. They would get the domestic / FTA allied country tax credit for the Australia, but then they would not get the tax credit because of the China content on processing. And so you would literally split the baby. And the other point is that the Inflation Reduction Act provides it has to be an increasing volume of metals that over time. So today it will be at 40% of the battery and battery pack has to come from U.S. or allied nations, and that will increase over time. So that creates a huge question. Will there be able to? Will the U.S. companies be able to meet this increasing percentage requirement over time? Given, it's much faster. It's easier to build a gigafactory than it is to build a mine, and so you have a meaningful dislocation just in terms of time to execute.
Look, I believe when you were over in Athens last month, you're addressing an annual government roundtable on geopolitics, environment and technology of the transition. You seem to be taking issue with this argument that we hear from a lot of politicians that actually going faster on the clean energy transition is a risk to actually energy security. Can you maybe go into that here? How does that work? Is that real?
Yeah, I really do have some challenges with the concept that we should, ideally we always want to have stretch goals, and it's good to increase levels of climate ambition. But if we don't put together the tools to execute, then we lose credibility in the policy, and it will lose favor amongst our publics, and it creates, challenges for all of us. We need to get this right, and so I think we have to be honest with the scale of the challenge that's being talked about. We're really talking about reorienting the global energy architecture. That is a material challenge of truly historic proportions. So it's going to take longer. The other challenge is is your objective, we have to be clear of our mission set, is our objective to accelerate clean energy deployment as fastly, as cheaply as possible to address climate change, or is our objective to develop a secure and reliable and responsible supply chain? That will cost more. So the first motivation will suggest that you should actually increase dependency on China because they have their incumbency, the scale, they're good at it. But that is not where the direction is for the country. So our politicians should start being a little bit more honest about both the objective, the target, and then how do we execute against it, or else we'll really be in a difficult trouble. I believe we can do it. But the problem is U.S., in particular, government politicians, ever since Jimmy Carter put on that sweater and lost his re-election, our politicians find themselves constrained by at the ballot box by energy prices. So that's why subsidies matter, because they offset, they mask the real costs. And that's why we have to get the rules right to do it properly. I believe we can do it. It just takes a higher degree of political will.
Well, so much more to talk about, but we've run out of time, I'm afraid. So please join me in thanking Frank Fannon.